Hello, everyone. Thank you so much for joining me today. For today's video, I want to cover some of the latest news out of China related to Tesla. And I also want to cover my Q1 estimates for Tesla's earnings, which will be shown on April 19th of this year. So without further ado, let's get started. I just had a bunch of coffee. Look out. I'm going to try to go as slow as possible. News from Sawyer Merritt on Twitter. Rumor, Chinese publication Sina Finance is reporting via industry insiders, quote unquote, that Tesla is planning a grand production capacity map for its new low-cost model. This low-cost model is a small Model Y. Tesla is building an annual capacity plan of up to 4 million vehicles per year for it, according to 36KR. Tesla is transmitting to the industrial chain 4 million vehicles will be distributed in global factories, of which the super factory in North America, which is Giga Mexico, I'm assuming, will undertake 2 million. And then Giga Berlin and Giga Shanghai will be responsible for 1 million vehicles each. Among the North American factories, the Monterrey factory in Mexico will be the main production capacity of this new, cheaper model. And thanks to Zi Zongwen 2005 for sort of getting us up to speed on these rumors. Very important to say that this is a rumor. And of course, as Tesla is building out the supply chain and the manufacturing processes for Gen 3, which they unveiled on Investor Day, you would expect to get some noise around these things. But again, it's very important to keep in mind that this is still a rumor, but I'll be tracking it very, very closely on this channel to see if there is any sort of, where there's smoke, there's fire. So we'll see where it goes. And this is also very interesting with the fact that Elon Musk is planning a China visit this week, which kind of, may align with some of those plans that Tesla's undertaking, maybe in Shanghai, and then as well as other things that are happening in that market as well. The next really big news out of China is that Tesla's about to start a large-scale test of FSD beta in China from Kaixin, and I hope I'm pronouncing that correctly. For any native speakers in the comments, do let me know if this is actually correlating to what's being stated on the header there. I can't, unfortunately, read Chinese, or I'm not really sure which dialect this is, but do let me know in the comments if this is correct. I see full self-driving down here, but I'm not really sure. However, there have been news that the Chinese market is beginning to adopt self-driving technologies, and this could be a big boost for Tesla in the near term if this were to become true, and again, could correlate with Elon Musk's visit to that region to maybe push that along or to just sign off on some of the last things that Tesla has to do from a full self-driving perspective. This could also coincide with the fact that version 11 of the full self-driving software for Tesla has been quite successful. I myself have found it extremely useful. I use it 100% of the time now. My wife used it for the first time yesterday while she was driving, and she said, yeah, this is great. So I'm wondering if a lot of this is tied to the fact that version 11 has become that step change that Tesla potentially was looking for and a lot of people were looking for. And of course, if this does go live in China, this means that auto gross margins should improve for the rest of the year because now you've just opened up a market, really the biggest market that Tesla's selling into, one of the biggest ones at least in the world, where you're going to have all these cars that are now going to have the software suite enabled. That's going to be basically 100% margin for Tesla moving forward. So pretty big news coming out of China, those two things, and I'm going to keep them. I'm going to keep tracking them very, very closely. Now let's go ahead and preview my Q1 estimates for Tesla's earnings. Before we do that, I would love it if you throw me a like. It helps the YouTube algorithm show this to more people. Thank you so much. Only if you're enjoying this content so far. Thank you so much. Now we know that Tesla reported 422,875 deliveries when they showed the delivery and production numbers on Sunday, and so this is going to be a very big piece of trying to understand where the earnings are going to fall on April 19th. Some of the big components that are not related to auto, as I'm thinking about the earnings report, is energy and the IRA battery credits, which is the Inflation Reduction Act. Tesla, as a battery manufacturer, will get some credits starting this first quarter tied to this bill. But really, the biggest driver for this report, which I think every single person is looking at, is at auto margins. And that's where I'm focusing a lot of my energy. But I really do want to cover a bunch of different things that, some of the clues that we have from the last statements from Tesla. The last earnings report that Tesla showed was on January 25th, and that's where they talked a lot about what they're seeing in the channel and how to think about the rest of the year. So I want to highlight some of those statements to try and piece together clues and data to see where this first quarter could end up. So there was a question on the earnings report from the investing community. After recent price cuts, analyst expectations that Tesla automotive gross margin, excluding leasing and credits, will drop below 20% and average selling price around $47,000 across all models. Where do you see average selling prices and gross margins after the price cuts? And here's the response from Zach Kirkhorn, the CFO of the company. So there's certainly a lot of uncertainty about how the year will unfold. Based upon these metrics, we believe that we'll be above both of the metrics that are stated in the question. So above 20% auto gross margin, excluding leases and credits, and 47,000 ASP across all models. They also expect them to be above it somewhere. So two other comments I want to make, just tactically on sequential ASP, which is average selling prices from Q4 to Q1. Just a reminder, average selling price reductions is not as large as a reduction in configurator prices, as in Q4, we had backlog customers that were delivering cars to at a lower price book given the backlogs that had been so long for so much of 2022. So a way to summarize this is to say that Tesla is expecting their gross margins before ZEV credits, the credits they get as a clean auto manufacturer, and before leases to be somewhere above 20% margin. Who knows if it's 0.1 or 7 points, but it's somewhere above it. And it's the same thing with the average selling prices. And the bigger piece here is that they're not expecting their average selling prices to drop nearly as large as the price decreases because of how their order books were set up for Q4, meaning that they were taking a lot of orders, or they were completing a lot of orders that were at a much lower price versus what they were selling at in that quarter. So the pricing in the first quarter shouldn't be impacted nearly as much as the price decreases, which sometimes were as large as 20% depending on the model. So that's a very helpful piece of information. Now, a question from Pierre. I love Pierre. He's one of the best analysts out there. And here was a follow-up on some of the comments that were made on the earnings call. If I look back at the COGS per car, which is cost of goods sold, basically how much it costs to make the car, you guys bottom close to 36,000 in the middle of 2021, and then the number went up as you had to face inflation and input costs from the COVID and all this other stuff, and Berlin and Texas. I think we were close to 40,000, and we peaked maybe close to 42,000. And then there was a question: how much time do you think it takes you to get back to this kind of 36,000? Because right now they're averaging around 38,000. And so here's Zach's answer. Austin and Berlin ramp in efficiencies in 4680 will make a substantial amount of progress over the course of the year, and that's within Tesla's control. We're doing a lot of work on cost reductions outside of that. On the raw materials and inflation side, where lithium is the largest driver there, and this was a meaningful source of cost increases for us, we'll have to see where lithium prices go. And so that's a very interesting piece of comment. Some of the follow-up here, we're not fully exposed to lithium prices, but I think in general, as what we've seen from our forecast here, cost per car of lithium in 2023 will be higher than 2022. So that's a headwind that would have to be overcome to return back to those levels. So I don't think we'll get there this year, but I think we'll make progress. Summarizing this comment, about $36,000 in COGS is expected for 2023 because lithium is a large component of that cost increase. However, if I keep track of the lithium costs in the supply chain, let's just doing a Google search and seeing how lithium prices are sort of changing. This is lithium carbonate. It went from 600,000 CNY, which is the Chinese yuan currency, and it's currently around 229,000 yuan, which is a more than 50% drop in lithium carbonate prices. It's important to also keep in mind that Tesla does work in lithium hydroxide for a lot of their batteries, but lithium carbonate is a good proxy to understand where the lithium prices could be for the rest of the year. But what's interesting here is that there is a trend reversal. From the comments that Zach made, they expect 2023 to be higher. However, there has been a very sharp decrease in lithium carbonate prices, and it's going to be interesting to see if Tesla is able to recognize those savings in Q1. So 50% plus reduction in lithium carbonate costs could be quite a big tailwind or a good thing that has happened to Tesla when it comes to absorbing less costs, making the costs go down. So a very interesting piece of information there. Real quick, I want to give you a heads up that I have a Substack in the description, farzadmisbahi.substack.com. Every single week on Wednesdays, we have an article covering EVs, energy, Tesla, technology, AI, and whatever else piques my interest. If you want to support that, I'll be very appreciative. Thank you so much. Then here's an additional comment from an unknown speaker. I think this may have been Lars. I can't remember who it was on the call, but some additional comments around raw materials. On non-sales raw material, we begin to capture benefits of indexes tapering out, but due to the length of various supply chains, it does take time before this is reflected in our financials. And while aluminum is down like 20% year over year and steel is about 30% down year over year, the global non-cell raw materials market continues to be influenced by geopolitical situations in Europe, high production costs due to labor cost increases, and energy spikes and disruptions due to natural disasters like typhoon, et cetera, et cetera. So we believe that meaningful price corrections will ultimately come, but it remains uncertain exactly when. And so there are savings in the supply chain that Tesla hasn't really recognized yet because of the different things they outlined. But what's interesting to keep a track of, those two things that that unknown speaker brought up on the call, is steel and aluminum are some of the biggest raw material costs that Tesla incurs when they're building a car. If we look at steel from the beginning of 2021 to 2023, we see this very big spike here in 2021, another spike in 2022, and 2023 so far has been quite significantly lower than 22 and 21. So the guidance I'm hearing is that a lot of these savings are still not being recognized. So we'll be curious to see if in Q1 that comes through. Same thing with aluminum, a big spike in 2022, and now in 2023 sort of evened out. It's not, it's kind of back to the 2019 levels, maybe 2020, not really, but it's lower than 2022, which means that there are savings in the supply chain for Tesla to recognize. Again, will be interesting to see if they can capture those in Q1. And then you also have Berlin and Austin, the two factories that Tesla is ramping, have now reached 5,000 units per week in Berlin, which will be very good for margins because now you're pushing more cars through that factory for the same amount of equipment and people. And the same exact thing for Austin at 4,000 cars per week. So these are yet again things that are going to help Tesla lower costs from that perspective. And then the last comment here I want to highlight before we get into the numbers, just to add and input some boundaries on what we're expecting in terms of impact to Tesla for this year. Different products we think will get different amounts of credit. The regulations here are still in flux and there continues to be updates. So this is just our best understanding at the moment. But we think on the order of 150 million to 250 million per quarter this year and growing over the course of the year as our volumes grow. And so, of course, this is directly in relation to the Inflation Reduction Act savings that Tesla is going to be able to recognize because of the bill going live in the United States. And so they're thinking at the bottom somewhere between $150 million up to $250 million, and then growing year over year because they're manufacturing cells in the United States through their Panasonic partnership, as well as the 4680 ramp in Austin. So this is something that we need to think about as we move into the next few quarters. So now let's go ahead and get into the numbers. I'll make sure to have chapters here on the video as well. If you made it this far, thank you so much. I hope this was informative so far. But now let's go ahead and get into the numbers. Real quick, if you do want to support the channel, I have merch in the description below. I have a link for that that you can follow. And I also have a link for Athletic Greens, which is a supplement that I use every single morning. You'll get free travel packs and vitamin D using that coupon. Thank you so much. So here is the biggest thing for me that I've been thinking through as it relates to the quarterly report for Tesla and how to craft my prediction. And so Tesla had insights into the average selling prices during the January call. Remember, they did this on January 25th, and they had done price decreases 1 to 2 weeks prior and some price increases as well to try and adjust the pricing to the demand. So they had very, very good understanding of where their pricing was going to be for the rest of the quarter. So that's a very big, interesting piece of insight that I'm going to use to really craft my earnings prediction. And so that $47,000 average selling price seems to be just about as solid as it can get. Of course, it could change. These guys are trying to predict multiple months out, and anything can change. But it does seem like that is a core principle or a core thing that I'm going to base my prediction on. It seems quite strong. So on the top line, if we look at my predictions for Q1 2023 versus Q4 2022, I'm thinking auto sales will come in around 19,900 million. Auto rec credits will go down to about 325. Auto leasing will go up sort of proportionally with what Tesla reported for a total auto revenue of 20,855,000. Energy, I think, is going to grow faster than it ever has quarter over quarter, just based on some of the guidance from Tesla, from 1.3 billion to 1.6 billion. And then services and other, I see going up from 1.7 billion to 1.85 billion in proportion to the rest of the business, bringing total revenue about flat quarter over quarter from 24.3 to 24 $3 billion. From the cost perspective, I'm seeing sort of increases on the auto sales from the cost perspective from 15.5 to 15.9, correlating with more cars being sold. But you'll see as we go down through the report that it's less cost per car, slightly, but it is less per car. Auto leasing proportional with the rest of the business, total auto cost of 15.7 versus 16.2 in the first quarter of 2023. Energy, I'm seeing the cost go up as well, but it's going to be at a better margin. You'll see it later in the report. And then services and other, again, proportional to the rest of the business. Total cost of revenue will go up from 18.5 to 19.3. And of course, you'll see that the revenue didn't really go up and the cost did go up, which is going to give you that margin compression that we're expecting in the first quarter of 2023. However, even with that margin compression, Tesla will report, I'm expecting about $4.9 billion in gross profit versus $5.8 billion for the previous quarter. If you look at the sort of the bottom section of the earnings report, R&D, I'm expecting to go up a little bit. Same thing with SG&A, no restructuring costs. And so the total operating expenses, which is what Tesla is well known for, their operating leverage, it's not really going up that much from 1.8 billion to 1.9 billion in the first quarter of 23. And then so that gets our income from operations from 3.9 billion to 2.9 billion. So $1 billion sort of loss for the previous quarter, but they're still going to be reporting, I'm expecting about $3 billion in income from operations. And now you have some interest income, interest expense, so on and so forth, which is tougher to calculate. But when it comes to the IRA, a credit that they're getting for the battery manufacturing, I'm baking this in the provision for income taxes because I'm still not fully, I don't really understand how Tesla is going to be able to capture that 150 million. I don't know if that's going to be in cost or if that's going to be in sort of the taxes that they're not going to be paying because it's a credit. And so that $150 million, I'm essentially calculating in this region, which is the provisions for the income taxes, and that's going to be proportional to how much money they're going to be making as well. So they're going to essentially save almost $200 million save in taxes because they're not paying as much because they're not earning as much that quarter, plus the $150 million that they're going to be saving through that credit. This brings the net income down to $3 billion, and then after you account for non-controlling interest and so on and so forth, you get down again to that $3 billion number. So I'm expecting Tesla to report about $3 billion of net income in the first quarter of 2023. If we look at some of the more in-depth detail here, deliveries, I'm expecting, again, they're reported up to 422,000. And then the ASP, the average selling price, excluding the ZEV credits, those credits for EVs and the leases, it's going to be around that $47,000 number. I only have it $59 above. And then the COGS are going to be significantly above that $36,000 target at around $37,600. So my average selling price is decreasing 5.78%, but my costs are only going to go down about 1.26%, which is, it's kind of like strange for me because Tesla has really guided towards big savings for the quarter, yet I'm not really recognizing any of those in this quarter, which I want to talk about a little bit more at the end of this video. So auto gross margin, excluding ZEV and lease, will go down to 20.1, which is right around that 20%. My energy gross margin is going to go up from 12 to 15, which you would expect with a ramp of the Lathrop factory and the Megapack 2 XLs. And my operating gross margin will go down from 16 to 12.2, again, to recognize the impact from the lower average selling prices. However, we still are keeping that auto gross margin slightly above 20% to be in line with Tesla's guidance. We'll see if that becomes true or not. However, this is the big number that's really messing with my brain because Tesla got it to a lot of savings in the supply chain. They don't know when they're going to recognize it. And we know Berlin and Austin is ramping, but I'm only having the quarter going down by 1.26%. And when I'm ensuring that the average selling price is around 47,000, my ASP is only going down by 6%. So this number here could surprise. This number here could be lower, which means higher margins for Tesla. So 20% margin requires about 1.2% reduction in cost, which we would just walk through at $47,000 average selling price. And so the core question of this earnings report for me is how much savings from Berlin and Austin ramp plus deflation in the supply chain will Tesla be able to capture in the first quarter of 2023, which I think is really going to dictate what kind of margins are going to report for this quarter, but more importantly, for the rest of the year as they start to recognize all those savings. And from that perspective, I really think Tesla has a chance for a margin surprise in the first quarter, and especially in the rest of 2023, as we talk about all those variables. In addition to them releasing full self-driving in China, which is going to add a bunch of margin potential to the business, because again, that's Tesla's first, if not second, largest market in the entire world, that now is going to be getting 100% margin software that they've never had before. So that seems like a big deal. So anyway, what do you think? Let me know in the comments what you think about this. A little bit of a longer video, but there's just so much to go through, and I wanted to make sure I give it the time it deserves. Let me know in the comments what you think. And if you like this kind of content, if you want to take part of the conversation, make sure you do hit subscribe, because these are the kind of videos I always try to make. I want to make videos where we have conversations in the comments to try and figure this stuff out a little bit more closely. And I see myself as somebody that just wants to present information and create conversation so we can all become better for it and really understand where things are going. So if you enjoyed this content, I would love it if you also throw me a like. And again, don't forget to subscribe. Links in the description if you want to support the channel. And I really hope this video was informative and helpful. And we'll see you in the next one. Take it easy, everybody. We'll see ya. Bye-bye.